Make sure you comment so I know who's here. That's the only way to enter the raffle to win the $20 Amazon gift card. Actually, I'm going to add that to a banner. So the way I do the raffle is I list everyone's name who was on the live stream, and then I randomly choose their name. And if you get picked twice, then I'll email you a $20 Amazon gift card. And every week somebody wins a gift card. So it's legit. It's not a scam. You just have to email me at this email address to claim your gift card. So all you have to do is comment, say anything in the comment section so I know who's here, so I could add you to the list of people. So we'll talk more about candlesticks because I think it's good to understand. I do understand what candlesticks are, but I don't really use them too much, or like charting patterns. I don't really use that too much to invest. But instead of just knocking it and saying that it doesn't work, I want to understand it better to make a better, conclusion. And I do see that there could be value in reading, charts. Let me just give you an example. So this is Apple, which is going to be a lot less volatile than most stocks. So maybe we should pick a more volatile stock. Leave a comment. Is there any good penny stocks I should do? I should look at the candlesticks charts for, because this is every half hour on January 3rd. Every half hour, the candlestick charts, and the bottom is the trading volume. You can see at the opening. So this half hour is that's okay. That's a close. Okay, let me start with the opening. So this is the opening, the first 30 minutes. Okay, VK, please just comment so I could put you into the raffle. And you might win. Okay, let's just pick one. Vion. And comment with tickers. ADR. I guess ADR is fine. Have you read William Green's book, Rich, Wiser, Happier? It's excellent. Okay, I'll check that out. I'm not a big reader. I tend to fall asleep when I read, which is not good. I wish I read more. But I like reading, like, I like, going online and reading articles, news articles. But when I read a book, I tend to procrastinate and not ever read it, or fall asleep. Okay, shot. Okay, let's do shot. I don't want to do an ADR. Okay, so this is shot, and this is the last trading day, which is January 2nd. Let me get the. Okay, so there's January 3rd, January 4th, January 5th. This is 3 trading days, January 3rd, 4th, and 5th. And it's every half hour. So every 30 minutes, what happened? I'm not even familiar with this company. let's just look at their market cap. Okay, it's not a small 1.3 billion, so it's not a penny stock, but it's fine. Apple is a little too like, I want a little more volatility. And this works with any stock. Obviously, the more volatile, the better. But just to put it simple, let's that's interesting. Okay, so the regular bar chart, this is the same thing, January 3rd, 4th, and 5th. The regular bar chart, it places dots at the closing price. So we're doing the 30 minutes. Every 30 minutes, so it closed at 3:09 at 10:30 a.m. So a dot was here. Then at 11 a.m., it closed at 3:27. So the dots connect the lines. So you don't know what happened. So it closed at 3:27 at 11 a.m. on the 3rd. So we don't know what happened in that half hour. Like, it might have actually went up to $4. It might have went down to $1. We don't know what happened in between. We just know it ended at 3:27. That's why the candlestick charts give you a lot more information. Like we do see on this, you see on the top here on the screen, it's in green. You can see it open at $3.09, which is here, $3.09. So that's when it opened at 10:30 a.m. It closed at 11 a.m. at 3:27. The high was 3:30. So it did go through 3:27. But that's why candlesticks are a little more user-friendly, because we can see what happened. Osman, what's up? Good to see you. Happy New Year. You're in the Netherlands, so it's not a bad time. It's probably in the evening. I just came back from Mexico. It was a lot of fun. It was really good. So the candlestick charts do give you a lot more information than a bar chart. So for instance, you see this chart right here? This is 10:30 a.m. So that's the 30 minutes, because we're looking at 30-minute intervals. That's from 10 a.m. to 10:30 a.m. What happened? Well, you can see the wick is way down here. So actually, the low, if you look, I can't really do it. But if you look up here, you can see the high, low, opening, close. Or you can look on the side here, but it might be easier to look up here to see the high, low, opening, close. So in this 30-minute time frame, which is 10 a.m. to 10:30 a.m., the stock, well, it's a red candlestick. So that means it opened up here on the top of the candlestick. So that means at 10 a.m., it opened at $3.10. And since it's red, it closed down here. And if you look on the top of the screen on the left, it says it closed at $3.09. So it's only 1 cent. So it's a pretty tight range. So that means there was really no conclusion. The buyers or the bulls didn't win, and the sellers, I mean the buyers or the bears, same word, buyers or bears, didn't win. The sellers and the savvy. I'm just going to use the term bulls bears because I'm trying to say both things. So when I say bulls, I mean people who want the stock to go up, and when I say bears, the people who want to go down. It did go down 1 penny, but it's really almost unchanged. It's 1 penny is not much. So there was no clear winner in this half hour, but you could see the bears really try to take it down, because look at that wick. It comes down to here. So if you look on the top of the screen, it says the low was $2.94. So the bears really try to take it down, but the bulls were able to kind of like avoid that, and it was really no clear winner between the bears and the bulls. Now the next half hour, you see at 10:30 a.m. it closes at $3.09 at 10:30 a.m. Now, the next half hour it opens at $3.09. It opens on the bottom because it's green, so that means it opened at the bottom. And then the bulls drove the price way up. They actually drove the price up to 330, the high, but it ended up ending the half hour at 327. So the bulls clearly won that half hour. They drove the price way up. Same thing with the next half hour. MPW tanked because their biggest tenant, what's the name of the biggest tenant? Stewart, right? Stewart. Their biggest tenant is having problems paying their rent. They still owe a lot of money from last year, and the fundamentals didn't change for MPW. It's just that their biggest tenant is having some money problems, so there is concern they may not be able to pay the rent. But we'll see. Oh, I didn't disable Super Chat. Is Super Chat not working? That's not good. If Super Chat's not working, is it not working for you guys? I don't know how if I could change it here on the screen. Shit. Okay, you found a button. Good. You scared me. And then the next half hour, it opened here because it's green, so it has to open the bottom. And the bulls clearly won because they drove the price up. They opened at 327. It closed at 334. They actually, it went as high as 335, but it came down. But then the next half hour, you can see it open here because it's red, so it opens at the top. And the bulls kept going. The bulls pushed it higher to 338. But then there was a lot of bearish activity, which drove the price down. It actually drove it down to 326, but it closed at 329. It makes people think MPW did not have funds to continue, but they just refinanced and sold properties to rearrange finances. I think MPW may be a good investment, but I don't know. I always get concerned, so it might come down more. I don't want to be like, that's why people say like, oh, why are you showing candlesticks? Like, just look at fundamentals. But like having a good entry point is important because like I manage my wife's money, of course. And she wanted to get into Google, especially when Google did that stock split. And she entered in February 2022. Wait, how could it be February 2022? Yeah. Oh yeah, it was right here at 146. She got into it, which I thought was a little high. I mean, it was higher a few weeks before, but this is its all-time high. Was in November 2021, about 150. So she got at 146. And Google's a great company. If you hold the stock for 25 years, it doesn't really matter when you got in. But if you hold it for a year or two, or even a few months, you may never make money. So it's been 2 years and we still are down on that investment. So that's what I'm saying. Even if you get the greatest company in the world, like Apple, you can buy it at the wrong time and it takes 5 years to get your money back. And most people won't sit on a stock for 5 years. So you can see pretty much, say you bought it anywhere between 2004 and 2014, anywhere, you'd be up a ton of money. Same thing if you bought it anywhere before 2020. Now it's trading at all-time high. Lander 484. Your comments, so I know you're here, so I could do the raffle. Now this chart looks like, oh, this would have been a terrible time to buy it. But if I do this video in 30 years, this right here is going to look like this, because in 30 years it's going to be way up here. So it'll be like a spec. Like it'll be like 2005 is $5 and 2013 is 20. So it's 4 times as much from 2005 to 2012, say. So 7 years later, it went up 300%, which is a big jump. But if the stock is trading at like $500, it's going to be a spec. So it won't even matter. It'll be irrelevant. Adam, Chris, thanks. Adam Jensen. So if you hold a real long time, doesn't matter. But the problem is people don't hold for that long. Some people, a lot of people, if they had Google at 140 levels and you're down like 30%, 40% on Google, you'd be upset. You'd be like, I thought Google was a great company. How can I be down so much? And they might just sell out because they're just so frustrated. Every day you look at your account and it's always low. It's always negative. But it's like if you bought it here, right? A lot of people, somebody recently told me that in the beginning of 2020, their premium collector, Ed A to Z, what's up? Somebody just NGL. Oh, it's up? That's good. I didn't check that one. Somebody told me their father died in the beginning of 2020 and they got a $50,000 inheritance from them. And then they said they put $50,000 into the market. I don't remember when they put it in. It could have been, say it was right here. I don't want to say it was at the peak. It could have been at the peak. I'm not sure. Say they put it at when it was 308, the market. And they said when COVID hit, they were down like 30, 40%. So they sold it because they didn't want to lose all the money. They needed the money. And then I showed him this chart. I said, well, yeah, if you sold it then and you took your losses, you didn't give yourself an opportunity to make a 50% return. Because not only would you have recovered from that loss, you would have made 50%. So yeah, so if you look at it in a short time window, you might lose money. You could time it right. Even if you didn't time it wrong, even if you bought it, say you bought it here in April 2021, which isn't the peak. So after a few months, you could be up like 20%. So you like, oh, I love it. I love the stock market. I'm making so much money. And then a few months later, you're down like 20%. So you just get pissed off because every day you look at it, you see it was green. Now you see it's red. And then you say to yourself, if it ever gets green again, I'm just going to sell. So it finally gets green, which is right here. So you just take your money and you don't invest ever again because you can't handle the ups and downs. But I guarantee if you just keep holding, but it's easier said than done. I mean, the tough part is if you were to time it right, it's right around the time when news is at its most negative and you start to fear. Yeah, it's the fear. I mean, I have that too. With Meta, I was so bullish Meta, and a lot of people made a lot of money on Meta. And like, you're never gonna get a chance to buy Apple at like a low level. It's just never gonna happen. So, like Meta, I bought Meta the day they started trading at $40. The day they started trading, and then and I was actually down. I don't know if you can tell. So I bought it at $40. I remember at IPO, and then people saying, "Oh, it's not good. It's too inflated," because they started trading at like a 200 billion market cap, something like, I forgot, something pretty high. Maybe it wasn't 200 billion, maybe like 70, 80 billion. I forget what it was. But it's pretty high market cap to start off. And then people saying that was bad. And then I was down 40% after like a month or two. So looking at this chart, it looks terrible. It looks like a terrible investment. But when you look at this chart, it's just a little blip. You can't even tell it went down. I mean, you could barely tell. And then I just wrote it up and I sold it at 400%. And then I bought back in. Let me see what I bought back in at. I didn't actually sell it. I sold options, and my options got called away because I was doing covered calls just to make money on all my shares, and they got called away. And I was pissed off. I did covered calls, so I sold it. I think it was like 300% profit. I did buy back in May 2017 at 150, and I bought 326 shares, like $100,000, I think it was, or maybe less. I can't remember exactly. No, $50,000. $50,000. It was $150 a share, and I was up 150% at the peak, almost 200%. No, like 150% at the peak, and then I ran into some money when I sold my business. I sold my business in December 2020, in December 2021. And the stock was already down 15% from the peak. So I put another 100,000 into Meta, and then I was down 70% from that investment. And it seemed so obvious. I should have just bought more, but I got scared. What news must come out for you to decide to sell a stock? I mean, it's not so much news. I mean, it could be news, but if I start to lose faith in the company, the management, if I don't really like, if I don't think they're growing as much as I like, but it's really more about like, it's really about like the business. Like if I just lose faith in the product and their future. So it's not just about the fundamentals, the income statement, the balance sheet. That's really important. But generally when I sell a stock, like if a company has a bad quarter, like they had a lot of bad quarters. That's why they kept missing their targets and the stock just kept crashing. But I didn't sell it. I like the company. I like the vision. I feel like they're always coming up with new things. Like they bought Instagram, which is considered the best acquisition ever. Or some people say one of the best ever. They paid $1 billion for Instagram, and now it's probably worth like $200 billion. So they're always innovating. So even if they have bad numbers for a quarter or a year, I'm not too worried. I'm more worried if I start to lose faith. Like Intel, I kind of lost faith in Intel. Like their market share kept contracting. But anyways, getting back to the fear factor, I was like, I remember my friend bought it at 200, and I'm like, he's like, it can't go lower. 200 for Meta, it's such a great deal. Hey Victor, what's up? Everybody subscribe to Victor. Great guy. We did a live stream. I hope he does one again with me because it was a lot of fun. He was a great co-host. So, and I said to him, I said, why can't it go below 100? And I was just saying that to kind of be a jerk because he said it can't go below 200. I go, why can't it go below 100? He goes, it can't. It's Meta. It just happened to, but I didn't think it would. And it's just so obvious. Like, why didn't I just buy more? I don't know. Because I put $100,000 into it and I already had another 100,000 into it. It's scary. But right. But yeah, Victor. Let me know if I missed your name. I want to do these raffles. Charles O. Adam Jensen. So when a company like Johnson & Johnson splits off 2/3 of the business units, what do you do with the stock value status? Would you consider Taiwan Semiconductor, or do you consider the chance of an invasion? No, I like Taiwan Semiconductor. I think it's a great company. They're not in China. Thank you, Victor. Always so generous. Well, generally splits are, I mean, the idea of a split is so each entity will be on its own and it should grow faster, because it's kind of like if you started a pizzeria, right? And that's your specialty, selling pizzas. And it was a good business, you making money, and your wife cool, Dr. Jonas. And say you were doing fine. You had a 200K in revenue, 80K in profit. So you were happy. You it wasn't a ton of money, 80K, but you liked what you did. It was enough to kind of pay the bills. And then your wife, who's say she didn't really have a job and she's like helps you out, and then she decides to like use some of the dough to make bagels. And she's actually doing pretty well, like not as well as you are, but like her revenue is like $60K, and you were surprised. You didn't think she'd even have $20K in revenue, and her profit is $40K because she doesn't have all the overhead. You pay all the bills. So you have this pizza shop, and then also in the pizza shop, there's bagels. So in the morning rush, people get bagels. And obviously you're splitting things because you're sharing a space. So neither of you can use the whole space, and you're sharing employees. So some employees may understand bagels better than pizza. So you could understand the dynamics, how it kind of works, but it would be ideal if you had your own space, your own marketing budget. So you just split, because the idea is if you split, maybe you can grow your pizza revenue from 200K to say 230K. I don't know. I'm just making up numbers. And profit of 90K because you were using most of the space. But the real benefit is your wife, because now she has her own space instead of a little tiny part of yours, and she grows it from 60 to 150, and her margins don't go up as much because now she has to pay space. So the idea of splitting your pizza bagel shop into their own individual stores, individual businesses, so you can really focus and grow. Your wife can really focus on the bagels, maybe make different kinds, and you could do that. Okay, Adam, thanks for coming. It's kind of the same thing with a big entity. They split so they can really focus on their product and not kind of be spread thin. So that's the idea. So yeah, it should be beneficial. So if you own a company and they split, then you do get paid for the split company. You might get shares in the company, or if they don't give you shares, you might get paid out. But they're really hard to value and understand because unless you have some like real deep knowledge of the business, I don't really know. I just have to trust management is doing the split for the right reason, and it's going to help grow both entities. The same thing if management acquires another company or management invests a lot into some project. I just have to trust they're doing it for the betterment of the. But a lot of companies screw up. You got 100K to spend on one stock. What are you buying? Right now, I usually buy the S&P index when I'm indecisive, and then I try to track the market, and then once I see something get to a certain like once I see something drop to a certain point, let's do this. Why do they make this so hard to read? There has to be a better way to do this. I'm always having a hard time. Candle overlays. Oh, this is crazy stock. Okay, so this is shot. Whatever. Oh yeah, so shot. So shot went up to 740. I don't know if this was IPO in 2020. It might have been when they IPO'd. But say I really liked I mean, there's going to be a lot of companies I really like. Say Shot is on my list of companies I really like, but I think the price is too high. So I would put the 100K in the S&P index, like this guy asked. So I always like investing. I hate money sitting there. Even if I think the market's overvalued, a lot of times I think it's overvalued and then it goes up another 20%. So I usually don't try to time the market in that sense. But I might time certain stocks. There might be 10 stocks on my list. And if I see it's at 740 and then it's down to 4, I might go in. And then, of course, I'd be pissed off for like a year and a half because I'm like, oh my God, it's down to 25 cents. But if I had steel balls and I just held out, then it got back up to $7. So this is a little too volatile. But generally, yeah, I have certain stocks. Like Netflix was an example of one I always write down my cost basis in my phone, so I don't forget. So Netflix, I have to like what the company does. Even if I don't understand the financials, whether I understand the financials or not, I have to like what the company does. I have to like the product. I usually don't buy stocks of companies I don't understand what they do, like Palantir. I did buy the stock though, but I usually try to stay away from stocks I don't really understand exactly what they do. I totally get what Netflix does. I love it, Netflix. And I remember in 2012, I wanted to buy Netflix, but it was up like 1,000% from like the IPO. Now you can't even tell, but in 2012, I was going to buy it, and then I held off. It was, they did a split, a 7-for-1 split. So, but it was like $100 a share at this point before the split. But I didn't buy it, and then it ran up to 700, and I knew it was going to come back down, and I always wanted to get a position in Netflix because I think it's a great company. So in January 2022, I bought it at 388. So about this point, I got it because I'm like, it's down almost 50% from the peak. I didn't think there's that much more downside, but I was down almost 50% after a few months, and I wish I would have bought more, but I don't have an infinite amount of money. I put 50K in here, and now I'm really happy. I'm up 35% on my investment. Of course, if I knew it was going to come down, I could have been up 150%. Yeah, premium collector. I'm really trying to get look at the penny stocks and trying to figure it out. I can't really do it that well, but I'm trying to figure it out. Neil Weston, thanks for being a member of the channel. So the number has to change. You have to get picked twice. So 12. So Ed A to Z got picked once, but you don't get anything unless you get picked twice. 14. And the number has to change for you to get 6. Maria won a few times. So did Ed. 17. Alibaba. ML Williams. Yeah, make sure you comment so I know you're here. 15. Wegro. So if I click it again and it still stays at 15, that doesn't count. It has to change the number. 14. Charles O. Make sure you email me at this email address. I'll try to do another raffle. So that's generally what I do. I put it into S&P index, and then when I see stocks I like, well, in this case, I sold out of my what's that called? It's called I sold out of my Waiter holdings. I lost a lot in Waiter. Such a bad investment. So I sold out of Waiter. I don't like selling stocks. I have a hard time selling unless I really lose faith in the company. So I sold my Waiter to buy the Netflix, which I'm happy I did. But if I generally don't run into a lot of money at one shot. You know, everybody just gets their paycheck a few thousand here and there each month. But if I got somebody passed away and gave me like $100,000, then I may have to possibly make decisions. Like when I sold my business, I should have put it into the S&P 500, but what I did was I had like $500,000 from the sale. So I put like 100,000 into Johnson & Johnson. I'm down 15% on that. I put 100,000 to Meta. I was down like 70%, but now I'm up like 1%. I put 50,000 into ET. I'm up about 50% on that. Plus I got like 20% in dividends. So that's the only one I'm really doing well in. So that's the thing. You sometimes it's better to not invest. When you have the money, put into something stable and then wait. Yeah, if you're a long-term investor, candlesticks probably don't matter. And if you want me to do a DCF, you can donate, and I could do a DCF now, and we could talk about the stock. Donate as much as you want, but at least $5 for me to do DCF. But if you want to do more, yeah, I don't really personally. I don't really care about candlesticks. I do find it interesting to look at, but I do want to like learn. Maybe there's more to. Maybe there's more to learn about it. Maybe I'm missing out, because I don't. When people say they're day traders, I pretty much in my mind I'm like, okay, so you lose a lot of money. I'm in my mind. I'm not thinking, oh, they must be really wealthy. I'm just like, okay, so you're Taco. I'm saying if you donate at least $5, then you can request a DCF, and I'll do it right now, which I'm going to do for. But I think most of them lose money, but maybe there is a way to identify patterns. And we'll talk about it more, because I'll tell you what I understand about patterns, and then maybe we can learn. Because if you start seeing if you see these really long wicks, that means, like in this case, this is a bearish day. It went down. These are weekly candlesticks. So this week, it was a bearish week, but you can see the bulls push the price up. You can see how high the bulls push the price up. So they really tried to get the price higher, but the bears end up winning out. So this could be a time for the following week to buy it, because the bulls put a lot of pressure on the bears. The bears did come back, but the bears can't win forever. The bulls can't win forever. In the long run, the fundamentals will play out as they should. But in short time frames, if there's a lot of people who want the stock to go up and they buy, pushing the price higher and higher and higher, there could be times, and that's what I'm not sure about. That's why I want to learn it more rather than just knock it. I think the housing market is pretty flat right now. It was really strong for a while. I think it was flattening out the market. It was declining a little bit, I think, in 21, 22. But I think it's coming back, but it's still not like prices, I think, are pretty flat with the past 3-4 years. Axelis. But the thing is with candlestick charts, with anything, there's no like guaranteed like way to make money. You have to combine it with other knowledge. In the long run, the bulls win more than the bears. But in certain stocks, the bears are going to win because certain companies are crap. Most companies are crap, actually. It's like there's 20 companies that like drive the market up. And these like 20 companies like Apple, Meta, Google, Amazon, Nvidia, they're the reason the market, these big Goliath companies. Like a company like Apple has the market cap of 10,000 small cap stocks, so or tiny stocks. So let's see. It looks good. Look at that free cash flow. It's going up. It went up 300% since 2020. Since 2020, 60 million to 240 million, and nice steady growth. Revenue looks pretty good too. It more than doubles. Let's see what the WACC is. ACLS. Yep. I have a feeling it's going to be a high WACC. Not that high, 10.5. See, it's very subjective because all these numbers, especially like the WACC, can really influence the results. So that's why I try to pick companies that make sense to me. 1.5, 1.235. It's really almost exactly at intrinsic value. My model says 121. The stock is 118. This is the kind of stock you could do DCF on because they have consistent growth and a positive. You can't really, it's hard to do DCF on a company with negative numbers, negative free cash flow. And it's hard to do a DCF on a company with volatile numbers, like up 100 million, down $1 billion, up 3 billion, down 4 billion. It's almost impossible. But as long as it's consistent, whether it's consistently good or consistently bad, like they could go from 100 million in free cash flow to 80 million to 60 million to 40 million. That's great because it's just consistency. Same thing if they consistently grow. But when the numbers are really wacky all over the place or negative, it's kind of like, it's really a guess. So this is an interesting case. So if I was to invest in Axelis, usually the first thing I do is just try to understand what they do. They design, manufacture, and service capital equipment for semiconductor manufacturing. So they're tied to semiconductor companies. They're not going to be as volatile as a semiconductor company because they're just providing the products for those companies to sell. So if Intel or Broadcom or Nvidia or any semiconductor company, if their sales, they're struggling to make sales, that company's stock will tank. Or if the market's getting soft on semiconductors, they're going to tank. But this company, although if semiconductors are softening, they're not going to be as affected because they're going to still have demand, because companies are going to still need to buy products from them, maybe not as many products. So they'll be a little less volatile. So the lows are not as low as like an Intel, and the highs are not going to be as high as an Intel. James Sketcher. I'm currently in Intel right now. Started off as a married position, rolled long up, put up with the rally. Yeah, I wish I held Intel, but I what's it called? I mean, because somebody said on a live stream, "Are you mad that you sold your Intel?" And I'm never usually mad, but let me just show you why, like how I could justify that I didn't make a bad decision. Although it did go up, but you see, I could have sold Meta. I didn't sell Meta. I sold my Intel. Intel, you can see it went from here to here. So it was higher. At Meta's lowest point, it was higher. And at Meta's highest point, Intel was lower. So I could have sold Meta, but I didn't. I sold Intel, which was a better decision. I mean, I guess if I had infinite amount of money, I just wouldn't have sold anything. But I had it. I can't remember why I sold. I think I needed money for something. I think I had put a new roof on my house and some other expenses. So I needed cash. So, but even if I did sell Meta, you know, I'm not going to like jump off a bridge. But in that case, it was a better decision to sell Intel than Meta. I mean, maybe I should have sold Johnson & Johnson. That would have been an even better one, because I don't think that's been performing pretty poorly. See, that's actually probably, when I sold my Intel, Johnson & Johnson actually probably went down. So if I sold that would have been a win, because Intel is the blue line here. Intel doubled in price. Johnson & Johnson probably went down. But I like companies that complement other companies, because it's much less riskier. Because if you want to open up a pizzeria, there's a lot of risk. You know, things could go wrong. But if you just sell dough to pizzerias, it doesn't matter if every pizzeria in your neighborhood goes out of business, because you sell the dough. You could just sell to the next neighborhood. You just have to maybe travel a little longer, or you can ship it. I don't know. So it's less risky investing in a company like this. But yeah, that's the first thing I would do. I at least understand the products and just see if there's demand at all. Like, for instance, a company like BarkBox. I mean, I used to get the product. I used to get in the mail. I used to get a box with a dog toy, dog food, dog snack. I like the product personally, but as an investment, I just didn't see it. I mean, it's a nice product, but in terms of like scaling and growing, I just don't see the demand. I don't see the need. Like, I'd much rather like Netflix. I'm never getting rid of Netflix, even when they raised the price, $17 a month. It's well worth it. I watch it plenty. Even if I didn't watch Netflix for a month, I would still continue my monthly subscription, because it's so low and it's just like I enjoy it. And this was more than Netflix, probably $40 a month. It wasn't too expensive, but it just didn't do it. It wasn't like, it didn't benefit me that much, because it started to becoming a hindrance. Actually, that's why I stopped, because I had so many toys, so many like little squeaky toys. There was just too many, because every box you get a squeaky toy. Along, the food was great, the snacks are great because my dog liked it. But so we grow. What are a couple of small companies that you recommend? Oh, they sell farm equipment. Axelis. Oh, it produces ion implantation systems, including high-end medium current implanters and high-energy implanters and curing systems used in the fabrication of semiconductor. Okay, so it was part of Eaton Vance, which is a big company, and it spun off from Eaton Vance. See, let's look at our 10Q. Axelis. So if I at least understand what they do and see, because scalability is so important. If you want to have if you want to like sell, like, if you want to open a laundromat in your town, it's a great business for a person to make an income and maybe hire a few people and maybe support your community. But in terms of scalability, I don't see it for certain products. Like, although I think Uber is great, like I think it helps people a lot. For scalability, I think it's a little rough, because it's very expensive. It's very very heavy on individuals, because you need an individual to drive every single person. You can't like you can't have one person drive 100 people at once. Every time somebody goes somewhere, you have to have a person driving them. So it's very reliant on people, and those people want a cut of the action. So it's a little harder to scale. Google scalability is great, because selling ad space, they don't need, every time somebody buys ad space, you don't need an employee there. Every single ad space spend, you can have one employee for 10,000 customers, and you can scale and grow, and you can sell all over the world pretty easily. Usually what I do next is I look at the income statement. I just look at their revenue. Nice growth, which is important, but I want to see what it entails. I could see mostly it's products. So they sell products, some services. Systems. So 230 million of systems. I'm not exactly sure what that is. And 61 million of aftermarket. So we can always search those terms to understand. I look, 52 million of their sales in North America. This indicates scalability to me. When they're selling 185 million in APAC and 55 million in Europe, they have the ability to sell all over the world. And that is really helpful, because if the US for some reason doesn't buy your product anymore, there's a big competitor, or if China, makes all these restrictions, it doesn't really matter, because if one country goes away, you have hundreds of other countries to focus on. So you can see they can scale, which is what I like to see. There's much less risk when you only sell US, or if you have a business and you only sell in your community. Like if you have a laundromat, nobody's going to drive an hour to your laundromat. It will never happen. Even if somebody's clothes, even if somebody's washer broke and every laundromat in that town broke, they're not going to drive an hour probably to you. So products. So what is product? I guess product revenue includes system sales, sales of spare parts, product upgrades, and new systems. Okay, so they don't support semiconductor companies. I was wrong. I misread it. They make their own products. Systems sales. So somebody said, so these are just the basic things to look at to just see if I even want to consider the company. Do they, what do they do? Is it a product that makes sense? Are they scalable? And if they're scalable, try to get a sense of how easy it is for them to scale. It seems, based on their revenue, it seems like they can do it pretty easily. And then you got to spend another few hours reading this crap. They are small caps in the pollution solution industry and the water solution industry, especially water solutions. Water solutions, that's a big industry. You don't realize how important water is. When I was in Mexico, I couldn't drink the water. And people who live there get sick sometimes by drinking the water. Even in the US, there's a lot of places in the US where people died from drinking water. The water gets polluted sometimes. And it's so important to have clean water. We need clean water to live. Not everybody, like our friends lived in Mexico, and they bought cases of water from Costco, like little bottled water, and they also bought big jugs so they can use it to wash dishes and things like that. But not everybody can just spend $100 in water a month. What's Flint, Michigan? Yeah, that's where they had a water problem. I can't remember exactly what happened. Is it still going on? I know it was a while ago. On April, the city of Flint changed their municipal water supply source. The switch caused water distribution pipes to corrode and leach lead and other contaminants. So this is a problem. It's you think it's such a basic thing, but it's very complex. The piping, if it gets disrupted. Taco, thanks for donation. Obama's famous sip. Yep, that's funny. Because think about it. If you have a home, say you buy a new home and say it's 100 years old, and say you're looking to kind of like knock down a wall, open up the space a little bit, that could kill you. That could kill your family, because the stuff in the wall, like the insulation, it won't harm you if you don't touch it. But once you disrupt it, then the poison, the airs, the poison or the dust gets in the air. You start breathing it in, and then you get really sick, potentially die. Same thing with water. If you disrupt the pipes, you make these changes, and it doesn't seem like you wouldn't even think of these things, but they think of it now because what, e.g. Everest Group. I hope that's not a financial stock. 17, 18, 19. So I first look at the future revenue projections, because that goes in my model. The future, future revenue. I need to whack to the discount rate, because certain stocks have a higher discount rate. They're riskier. Certain stocks have a lower discount rate. 9.3, that's pretty good. When rates went up, discount rates were a lot higher. Now I need to find out where they're trading at. So I get kind of my starting point. Wow, 371, 16 billion. Now I got to get the actual numbers, what they've actually done. That looks good. A nice steady growth. This should give me a value that makes sense. Revenue, that looks good too. Up about 50% over the past 3 years. This seems awfully high. Huh. Let me make sure I did everything correctly. $370, 16 billion market cap. They pay it almost 2% dividend. I think the future growth is too aggressive, because it goes from 14. Let's try to stabilize it a little bit. Okay, so this is a more stable growth. Yeah, I'm trying to be conservative. It seems really undervalued. 860. Why is it so undervalued? Wow. Look, and it's trading at all-time high. It was only $20. Well, that's 96. That was a while ago. It's really done well. It's just killing it. Oh, okay. That's why it's. So it's come down. It was over 400. It does look too good to be true. Why is it so undervalued? Does anybody know? I mean, 16 billion is not a small company. What kind of company is this? Oh, it's an insurance company. That's why. Okay, that makes. So you can't. It's hard to do a DCF on an insurance company. They're one of the hardest companies to value. It's a little more complicated because they don't have traditional. Same thing with a bank. They don't have traditional revenues and profits. Because if you think about people, like when people put money into their bank account, it's not really the company's money. even though technically it is their money because they lend it out. So it's a little, you can't really, it's a little more challenging to value. Let's look at price to book is a good measure for an insurance company. 1.44. Insurance, they do reinsurance. Do you guys know what reinsurance is? I could explain it. I worked at an insurance company. Reinsurance is a pretty safe. No, it's not insurance for insurance companies. Does anybody know what reinsurance is? Good guess, though, but I mean, it could be insurance for insurance companies, but it's insurance for anybody, any type of company is reinsurance. But specifically, what is reinsurance? Like, how's it different from like property and casualty insurance or any type of insurance? Come on, jeez. Why is this not working? Let's see if we could just look on Excel. So Everest is the biggest. So a lot of these metrics don't really apply to insurance companies, like cost of revenue, appreciation. Well, let's look at dividends. So they pay the highest dividend, 6.7%. Insurance on insurance? What do you mean insurance on insurance? Reinsurance is regular insurance. It's not like is reinsurance more risky? No, I think it's the same risk. Oh, that's different. Oh, this is dividend yield. Okay, so they pay 1.8%, a little lower than. A little lower than RGA, which is 2%. So price to book is usually the best metric for these companies, and they're 1.3, which is worse than the average. A little better than the bottom companies, but they are better than RGA. Yeah, I mean, it looks good. It looks good, but it takes a little time to really understand it. Everest Group. Let's just see what. They don't have a Wikipedia page. I mean, so reinsurance is so let's what type of insurance do they do? What does Everest Group do? Strategic research insights on IT process engineering services. Is that the same? And a lot of insurance companies are in Bermuda for the tax shelter. Our purpose is to help members make better decisions. We do this by I just want to know what products do they insure? Okay, property, casualty, and specialty products through its various. Oh, here. Everest Group is Bermuda provider of reinsurance and insurance, operating close to 50 years. U.S. 1973 was founded. They do both reinsurance and regular insurance. So just put it simply, say company X, say company X does property and casualty, just to simplify it, and they only operate in, say, 3 states: New York, California, and Texas. And then okay, insured amount. So this is the amount of risk they have, the amount they insure. This is what they actually insured. Say, so $10 billion in New York, $12 billion in California, and $8 billion in Texas. So they insure a total of these are all billions. So they insured $30 billion to their customers, but they may have a rule in place, and insurance companies are regulated, so they have to follow certain rules legally. They can't, like a bank can't just lend out all the money that's deposited at the bank. They have to keep some money in case people need to take money out of the bank. So they have like a rule. They can only lend out up to 80% of the funds in the bank. So insurance companies have rules too. So they might not be able to like have more than 50% risk in any one state. I'm just making this up. I don't know the exact rules, or maybe it's an internal policy. So they say it's their internal policy. They can't have more than 50% risk in any state. Percent. So they're good in that category. They didn't like break that rule. And say another rule is they can't have more than 10 billion insured in any state. This could be an internal thing. They just don't want to have more than 10 billion in any state, just in case there's a problem in that state. Like there's a big earthquake in California, I don't know, or there's a huge state tax and people leaving California. So they don't want to have too much risk in any one state. So they have these kind of like and this is pretty easy to look at. We don't even need to do formulas, but if there was, 50% 50 states or hundreds of countries. You have all these spreadsheets, and then you have to, what did I do? Oh, I put 12. You have to look at all these ratios to see if there's anything that's broke the rule. So there you go. So they broke that rule. So they say, okay, we have 12 billion in California. The rule is we can't have more than 10 billion in any state. So what they do is they go to company Y, and company Y takes 2 billion from their California insurance. So they give company Y $2 billion of the insured policies from California. And that's pretty much what reinsurance is. When another company gives you the insured products. So according to your policy, you see company X's name because they're the ones who underwrote your policy. So you still call them, you still work with company X. You don't know about this reinsurance program, but company Y said, okay, we'll take $2 billion off your books and put it onto ours. And then say, say there's $100 million in fees that, well, maybe that's too much. So let's say the $2 billion in fees, they charge the customers $10 million. I mean, $2 billion in insurance, they charge $10 million in fees. That was, that's how they make money. Just like when you get car insurance, you have to pay a premium. So 10 million premium payments from this 2 billion. So they give company Y like 9.5 billion of the 10 billion. Or maybe they give, and they keep $500,000 because they still have to kind of like answer the phone when the people call or whatever. But company Y is taking the risk. So if these people default on their policy, company Y has to pay. So that's what reinsurance is. It's if you have too much risk in a certain area, you give it to another company, and that's reinsurance. They reinsure. Do you prefer insurance companies like Geico and Market that aggressively invest their float in stocks, or do you prefer the ones that stick to short-term fixed income? I don't know. I mean, it's kind of hard. Are you back? Yeah, I'm back. It was really fun. I was in the Yucatan in Mexico. I like Geico a lot. Adrian, what's up? Thanks for your comments on the videos. So reinsurance, there's nothing, and this is just a practice insurance companies do. They reinsure to each other because they have to follow these rules. They have to be within limits. And like a company can have, they can have PNC insurance, car insurance. They could have rental insurance. I mean, I'm sure a company wouldn't have all these, but they could have medical insurance, and they might just, it's regulated, so they can't have a certain amount based on how big the company is, of course. If the company has $1 billion of like cash and 50 billion of insurance contracts, like the rule is based on their parameters, they can't have more than like 30 billion of PNC or 10 billion of car insurance. So once they go through these levels, because it's inevitable, you do go past these levels for whatever reason. Like if it's a percent thing, like say for instance, I mean, is this boring? Or is this interesting to people? If it's a percent thing, then it's hard to control because say they're not allowed to have more than 50% in any type of insurance product. And right now it's fine, but let's just say for some reason they can't insure medical anymore, or like there's a company that comes out that is giving great insurance, or America changes to where everybody gets free insurance and nobody pays for medical insurance anymore, except if you want like the best doctors and you have to pay, but everybody gets free. So they go from 30 to like 2% medical. Let's just pretend PNC was 40 already. So right now they're fine. They're below 50, and then just medical changes as these new laws, and they're above 50 in PNC. And really, that's not a fault of not their fault. They didn't foresee this happening. It's not like they wrote so many more policies for PNC. But so they just have to reinsure. They have to give it to another company, so that other company takes the risk. So that's what reinsurance is. Because when you're in a regulated industry, legally you have to follow rules. Like if you're an accountant, you're regulated. You can't file taxes unless you're a CPA. I mean, you could as long as you don't get caught. But you can't take money. You're not supposed to charge people money to file their taxes. It's illegal. I'm not supposed to give financial advice because I don't have whatever the Series 7 or whatever. So it's highly regulated insurance, which makes sense because some people have their life on the line with insurance companies. If their house burns down without insurance, they're homeless. So that's why it's highly regulated, and they need companies that will be able to have the funds to pay those their customers. The problem with eBay is that they're just not popular anymore. That at least compared to the past. If it wasn't for Venmo, they would be like a penny stock. With Amazon, because the interesting thing is, like, if you have a company that's making a ton of money, and has been around decades, and a lot of people still use your product, like say you're eBay, and you have this amazing platform that's innovative, like it's for like from the late 90s. I got eBay in 2000. From the late 90s when it started up until like 2010, it was just like nothing came close to it. It was great. It was innovative. People were using it. They made tons of money. But once Amazon comes out, even if eBay is still making a ton of money, people just will stop buying the stock because they know it's just a matter of time till they either go out of business or lose a ton of market share. So they just Amazon's out there, so they're not going to ever probably be the giant they once were. Venmo is like keeping them afloat. So let's see. eBay. I mean, this only goes back to 2016. So it looks pretty good. It was 9 billion. It got up to 11 billion. But they're not really growing. And I wonder what their revenue was in prior years. Okay, so their pinnacle was 2012, 14 billion. And then look at Amazon. I mean, they're still growing, and they're half a trillion. So that's where people put their money. So it's not a small number, 10 billion, but when your revenue declines or even flattens out, then people just think it's gonna keep going down until it just goes away. Like they totally lose faith in a company. Like a company, people buy. Well, let's look at a stock. I bet you it was so inflated, the stock, at some point. So it's hard to tell with the stock splits. I mean, it looks like it was under $1, but with the stock splits, it probably, but it percentage wise, it still makes sense. So it went from like, say, $1 to $23. So it went up 23x from 1999 to 2004. And then Amazon just probably, it's actually, it goes further out. So it went from $1 up to 80. That was its peak in 2021. So is it a good time to buy eBay? What do you guys think? If someone tells me that they bought something online, they definitely aren't saying off eBay anymore. What's wrong with eBay? I use it. I actually use eBay a lot. I rarely use Amazon. I like eBay a lot more. And another problem with eBay is that they kind of split from PayPal, because it used to be PayPal did everything on eBay. And then they kind of broke apart. So it's I think that was the moneymaker, right? PayPal. Because they were one company. What's eBay's revenue? Okay, so 10 billion. And PayPal is also struggling. What's PayPal? 27 billion. So I think that was the problem. Like, PayPal is a much more profitable company because it's all margin. Like, they just transact and they take a fee, which is like, it's all profit. There's really no, very little expenses involved to do that. There's obviously payroll and technology, but its scalability is huge. eBay, the profits, it's not as profitable. It's still profitable, but it's not as scalable and profitable as PayPal. But that's why the reason Baba is even as strong as it is because of Alipay. Alibaba owns Alipay. Alipay is like PayPal for Alibaba. And that's like, they make a ton of money. They do like they do so much more business than PayPal. Alipay. Let's see. I don't know what that's for, but Alipay, PayPal. Don't they have a chart showing all the payment providers' revenue? What's this for? PayPal. That's why don't they have? I guess they don't. So PayPal is still big in the U.S. Okay, Alipay, PayPal transaction revenue. Sure don't make it easy on these. Okay, let's just say Alipay transaction volume. Maybe I'm using. Okay, here's a good chart. So no, here's a number of users on the platform. Alipay 1.3 billion, PayPal 370. So they're like about 4 times as big as PayPal. But Venmo is down here. They're tiny. But yeah, I think that's the problem with eBay. They split from PayPal, and PayPal was the revenue where they made most of the money. And with Amazon coming into the picture, it's killing it. But Venmo is a good app. So that was a smart acquisition to get Venmo. I don't know about let's see, eBay. So the US is about half. UK, China, Germany. I don't think they give a breakdown for Venmo in their financials, which I don't understand. They should. They don't even mention the word Venmo. Am I going crazy? They own. Wait. Oh, PayPal, right? PayPal owns Venmo. What am I saying? Yeah, PayPal owns Venmo. So that's why. Yeah, eBay is just That's why you got to use the candlesticks to identify a time to buy these companies. So here's PayPal. These are the daily charts. So a hammer. Let's see if we find a hammer. Well, a hammer is just where there's a block on top and just a stick on the bottom. So I don't see any hammers. Which means the highest price is the closing price. And we're looking at weekly. Okay, here's a hammer right here. So right here, when there's a block on top and a stick on the bottom. So that means there was selling pressure because it did get lower. But ultimately the bulls won because it ended up closing up here. And the longer the stick on the bottom, the more the bears try to push the price lower. But the bulls ended up winning. And the opposite, this is also a hammer. It's a red hammer though. It could be green or red, the hammers. And an inverted hammer is kind of the opposite. When there's a block on the bottom and just a stick on top. This is pretty much an inverted hammer. So there's a lot of buying pressure. The bulls are buying and pushing the stock higher. You can see the stick over here. The line kind of hides the stick, but ultimately the bears brought it back to reality. So if there's a lot of volume and you see like a lot of buying pressure, but it ends up going into the red by the end of the day, or in this case, the end of the week, that could indicate there's going to be a bullish trend. So you could see the following week, the same thing. The bears pushed the price all the way down to 245. The bulls ended up bringing it back, but it closed down here at 253. So it opened 264, closed 253. Same thing the following week. The bears, this is like looks pretty close to a hammer. So the bears pushed the price all the way down to 234, but the bulls tried to maintain, but it ended up becoming a bearish week. This is a little kind of like there's some bullish activity and there's a little more bearish activity down here. So the bears were more aggressive, but it ended up being a bullish week. So finally the bulls are in control and you see a few straight weeks of bullish activity. When there's like a cross, like there's like a really thin line, which is here. You see like it got up here and it got down here. It got down to like 259. It got up to 271. Like a cross. That indicates kind of indecision between the bulls and bears. There's no clear winner. They both try to push it to one end, but nobody really won by the end of the week. It's kind of like a tug of war. If one side really, really wants it and puts their all into it, they're going to win. But if there's nobody's really pushing for it, nobody wants to exert too much energy, so they wait another week. So I don't know. I don't know if this is a way to identify price movements. I'm going to see if I can figure it out. Like you can see, there's a like green, red, red, green, red, red, green. So lots of like kind of like back and forth. But it's trending down. Even though it's back and forth, it's still trending down because the bulls were more control. Because even though there was a green day, it didn't go up that much. And the reds brought it down. Then the following week, it's just back and forth, back and forth. I still buy from eBay, but yeah, it's true. People don't brag about. How about we do some small semiconductor stocks like Indie or ISCC? But then, like, it went from 266 all the way down to 182. So the bears really crushed it over the next few weeks. So how do you know? How do you know if the prior week indicates? I mean, there was really no bullish activity. You could see the wicks when you look on top, look on the wicks. There's really no wicks. It was all the bulls really had no power. It was all bears, 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 like a huge sell-off. So that could have been an indication. And they were big weeks, like big drops. This is small. Yeah, Musk's yeah, he's a lot of talk, Musk. I don't know if he'll develop I don't think he'll develop another company as successful as Tesla. But let me know about the about charting, and if you have ideas on candlesticks or anything, we can talk about it. I could try to implement it into my video. Maxiano Acosta. Stall. And make sure you email me if you win the raffle. The bulls, the bears, the bulls. Okay. Number one. Most people probably left already. 22. 11. And if you don't claim your prize within 24 hours, it expires. Because I can't like have people say, "Oh, I won last week. I didn't claim my prize," because I can't keep track of it. So you have to claim it within 24 hours, or you can't take it. Because I can't. 8. 23. You have to get picked twice to win the $20 Amazon gift card. 3. 19. 21. Lots of picking. Lots of people are going to pick once. 26. 14. 4. Wow, look at this. This is crazy. 17. Baba. 21. So James Sketcher wins the second one. I think Charles O won the first one. Okay. So if anybody wants it to do another DCF, if anybody donates, in Colombia. I'm in Colombia if I win. Colombia. Do you live in Colombia, or are you on vacation? Okay, so I guess I'll log off now. Thanks for joining. Try to watch. I just did a video on Altria today, so I have to edit it still. But that should come out later today. North Korea. Nice. Santa Fe. Okay, yeah, I'll see you later. Talk to you soon. Maybe I'll do a live stream tomorrow. Thanks a lot.